The chart of the Japanese yen is in free fall. This is a major issue for Japan's economy. 10 years ago, the Japanese yen was worth about $80. However, it is expected to trade for more than $150 in the coming months and currently trades for around $140. Nothing has been seen yet. The government has now been forced to introduce several strategies to moderate the situation for the first time since 1998.
You are watching Optimize.
Another nation with a strong currency has seen its currency devalue once more. Yes, I am referring to the Japanese yen, which has been steadily declining. This year, the Japanese yen is falling against the US dollar to levels that were last seen decades ago. You might think that this is a problem that only affects Japan, but you would be wrong. The entire world, but especially the United States, will be affected in some way as the yen falls and causes economic turmoil in the country. This video will discuss how Japan's economic crisis is being brought on by the falling yen and how this will have global repercussions. The international community is interested in what is going on with Japan's economy, primarily because it is something that was anticipated for a considerable amount of time. Investors have traditionally purchased the yen as a safe haven during times of crisis. Things don't look right now. The yen also deteriorates as Japan loses that status and sinks deeper. This year alone, the Japanese yen has lost more than 20% of its value against the US dollar, bringing it to its lowest level since 1990. It makes sense that this issue requires immediate attention. I'm sure the first thing on your mind is, why is this happening? Okay, let's call it a decline. Because the word collapse is too harsh. The disparity in interest rates between Japan and the United States is largely responsible for the yen's decline. If you didn't already know, policies in the United States could have a significant impact on other economies. That is the influence that comes with owning the reserve currency of the world. In the interest of its own people, the United States Federal Reserve has been aggressively raising its main interest rates this year in an effort to combat inflation. The rate has increased to 4% from 0.25% in March this year. With each subsequent month, the Fed has increased it. This contrasts with Japan's own interest rate, which is currently negative 0.1%. You read that correctly. I stated that the interest rate in Japan is negative 0.1%. Issue with Japan's low interest rate compared to the United States' significantly higher rate is that higher interest rates typically make a currency more appealing to investors. As a result, there is less demand for currencies from low-rate nations like Japan, which causes their value to drop. When you take into account the fact that the value of the dollar is rising while the value of the yen has been falling, you can see why the gap between the two countries is so large. All of this is more than just a currency that is falling. The Japanese economy appears superficial. Over the past 3 decades, its economy has barely expanded at all. In 3 decades, it has only increased by about 1.62%. To be honest, the economy has largely remained stagnant. Because of this, some experts believe that the weak yen is a reflection of the country's finances, a point that may have some truth. The problems with Japan's economy do not end there. If you haven't already been aware of this, you might be surprised by this point. It just so happens that Japan is the country in the world with the most debt. With a debt that is 245% of its GDP, the island nation has the highest national debt in the world. Japan's current problem combines a stagnant economy and rising debt, which no nation wants to deal with simultaneously. In addition, Japan faces the Asian demographic time bomb of having the highest proportion of older people in the world and a low birth rate. That casts doubt on its capacity to uphold economic structures when the working population is unable to meet demands. Despite the fact that this is a social issue, it is wise that I bring it up here because it has significant economic consequences for the nation's economy. Even experts like Takashi Fujimaki, a former advisor to billionaire investor George Soros, have stated that there is no reason for the yen to strengthen when you take into account all of the factors that we have discussed. He has frequently written articles in which he has stated that he anticipates the Japanese yen to reach 180 against the US dollar before ultimately just collapsing in value. He has been screaming about the yen's shortcomings. Likewise, things certainly appear to be moving in that direction. You might be thinking, if you want to be competitive, just raise the interest rate. I actually considered that as well, but it seems like it's not so straightforward. The governor of the Bank of Japan, Haruhiko Kuroda, has repeatedly made it clear that the Japanese economy is insufficient to withstand higher interest rates. Well, that presents quite a dilemma. When the economy is already too weak for an interest rate increase, how do you raise rates to improve the currency, which is supposed to boost the economy? What hassle! It is anticipated that the Japanese interest rate will remain roughly where it is currently until Kuroda retires in 2024. This indicates that the situation you are experiencing now, if not worse, will continue for the foreseeable future. This is a very interesting story about Japan, but it's not all bad news for Mr. Kuroda and the Japanese government. Because of the economic crisis and the problems it brings, inflation has started to creep into the country. Comparing Japan to any other nation and the United States, rising inflation is a problem. However, since Japan has historically experienced deflation and falling prices, inflation is a positive development. This was bad for them because it didn't encourage a lot of consumer spending. After all, citizens don't want to spend much because they think prices will go down more in the future. This doesn't keep money in circulation a lot, which hurts the economy. Because of this, Mr. Kuroda said that the bank's current policy is needed to help it reach its goal of 2% inflation. But that's fine. That is how much the government can do. Let's talk about what it has actually done, which is a significant move. The Japanese government has been happy to observe from a distance. However, the government decided it would be wise to intervene as the yen continued to fall heavily. In an effort to halt the decline in the value of the yen, the authority intervened in September by purchasing it for $21 billion. This took place at a time when the yen was at all-time lows. According to Vice Minister Kondo Masato of the Finance Ministry, the government had intervened for the first time since 1998 because it was required. He stated that the government has recently taken decisive action in his remark. However, this strategy only worked for a short period of time because the currency started falling again, this time worse than before. You can see that the goal of the government's intervention was to strengthen its currency. This is how it works. Buying the yen lowers the market value of the currency while increasing its supply. However, as monetary tightening increased the amount of money in the market, the Bank of Japan's ultra-loose policy had the opposite effect, resulting in a decline in the yen's value. It's like stepping on the gas and the brakes at the same time when the government buys the yen and the Bank of Japan keeps its easy stance. This might have led to the government's efforts being rejected. According to economist Kumana Hideo, officials are acutely aware of the intervention's limited effectiveness. He stated that the government is aware of the limited effects of an intervention. Consequently, it launched an unexpected attack. So to speak, immediately following all significant financial decisions, you employ such a strategy when you are aware that your battle strength is lacking. So to speak, but the government can only intervene for so long, regardless of how often it does so. On paper, the foreign exchange fund special account held by the Japanese government contains approximately $1.3 trillion. This suggests that the government can simply continue to intervene, but this is completely false. Since a significant amount of that money has been invested in things like bonds issued by the United States government, the government's liquidity may not actually be that great. Because it is impractical, it is very likely that the government will not continue to intervene for an extended period of time. Additionally, a number of experts have cautioned that these efforts to support the yen will only have a short-term effect. If the government's most recent efforts are taken as evidence of this, then it is clear. We are all aware that these policies and crises affect everyday people. Therefore, what does this mean for you? Firstly, the weak yen increases the cost of everything purchased in Japan. The island nation will spend significantly more on imports because of its reliance on imported oil and gas. As the value of the yen has decreased throughout the year, import prices have increased. The economist Kumana Hideo noted that the yen began significantly weakening in March. If the currency exchange rate changes from 115 yen to, say, 145 yen against the dollar, that will cause import prices to rise by about 30%. As import prices rise, so do the prices of imported goods. These effects are currently affecting people all over Japan, with shoppers lamenting price increases. When you take into account the fact that Japanese consumers' purchasing power has decreased by half over the past decade, this situation gets even worse. For instance, whereas 10 years ago, 10,000 yen could buy an item that was worth $132, today's average citizen only gets something that is worth $67. This is absolutely unacceptable, given that average salaries in Japan have barely increased in the past 3 decades. This comes back to what I said earlier about the economy's stagnation. If you are Japanese and need to travel abroad, pay for things abroad, or send your children to school abroad, you must find the current situation absolutely unacceptable. The only bright spot is that if you earn money abroad, you're good to go because the money will be worth much more at home because exports make up about 15% of the economy. That is a significant number, so where does all of this discussion leave us? Well, we have a nation whose currency is depreciating at a rate previously thought unimaginable. Consequently, the nation is nearing the brink of an economic crisis as a result of this decline in value and its stagnant economy. The citizens are dissatisfied and exhausted as a result of their daily loss of purchasing power and the ineffectiveness of government interventions. After the Bank of Japan's current governor retires, the country will only have one advantage. Maybe they will appoint someone who will raise interest rates. Alternatively, they can just hang on until the US stops hiking its own interest rates. Either way, for a superpower like Japan, none of this looks good, and none of these options can be regarded as a solid strategy. For all intents and purposes, Japan is in Hail Mary territory now. However, I hope nothing goes wrong with their economy. What can Japan at least do to save the yen? Comment below, and we will meet in the next video.